11/10/2012, 8:03 a.m. Pacific Standard Time. S&P Midcap 400 weekly chart is broke from the bull rallies that we experienced in the first calendar part of 2012. We are having some experiences right now this time of year in November and December, just as we did 1 year ago when we were putting the bottoms in. Then we got that great rally in 2012. Why is the S&P 500 mid cap very, 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 very important in here? It's because it's a great gauge of the economy, fiscal cliff, and many, many other things that could hit this market. That's what your pundits are talking about. These are the names that trade in the S&P mid cap index. There are some leaders in here. What we care about is what's the difference between the mid cap and the small cap. This mid cap is in the mid range of everything in our economy, and there's 400 stocks in here. I just showed them, but here I'm below the 10 week, I'm falling below the 20. This particular index is very crucial because that 50-week moving average is going to come into play. 954.56 is the 50-week. The 100-week is down below there. We have what we call a 4-week weekly closing below the blue line is a 10-week simple moving average, and that 20-week is selling down. These support levels are going to be critical because you're going to come down to the 50-week and then down into the 100-week, and we're going to take a look as we move forward through this calendar year, ending the calendar year. Remember that November and December are supposed to be the greatest 2 months of a calendar year in Wall Street. However, with the Obama election, with the fiscal cliff, with the negotiations, and many, many, many other things about big government, is that unless there's something done and some kind of agreement's met, the mid-cap 400, which is really the heart and, part of the heart and meat and potatoes as far as mid-cap ranges in companies, that we want to see the 400 and the small cap be able to hold up. So we are in the very beginning phases of a bear reversal for the fact that we're closing 4 weeks below the 10-week moving average. This is the calendar first yearly correction that we had from the bull run right here, as you can see. You can see this correction, and you can see we made all-time 5.5-year highs. However, it's broke right now. The longer-term trend of that bull of calendar 2012 isn't completely broken, but it's weakening now. So there is a difference between bull and bear, and the more that we come down, that means that that bull trend that we've experienced in the calendar year becomes much more weaker and weaker and weaker. Once again, we're updating our worldwide network, S&P 400, mid-cap. This particular index is very crucial to the broader market. I'm below the 10 and the 20, and we have a high alert because what we're going to be looking at, MMTs, is where the broader of these very important indexes, if they're all going in the same direction, that means that the longer term bull trend that these have experienced in calendar 2012 will weaken considerably, and you should be very cautionary.